The Property Bulletin by London Property, the home of superprime.
Qatari Prime Minister Sheikh Mohammed Abdulrahman Al Thani has recently completed a notable transaction in London's luxury real estate market, selling his Mayfair mansion to another member of Qatar's ruling family for £39 million, about $66 million. This deal ranks among the highest-priced residential transactions in the city over the past year. The Grade 2 listed mansion, situated between Hyde Park and Berkeley Square, was originally purchased by Sheikh Mohammed in 2021, according to UK filings. The identity of the new buyer remains undisclosed. Such inter-family property exchanges among ultra-wealthy individuals often serve various purposes, such as minimizing agency fees or mitigating inheritance tax liabilities. Sheikh Mohammed, an esteemed diplomat who assumed the role of Qatar's Prime Minister last year while continuing his tenure as Foreign Minister, directly negotiated the sale with the fellow royal buyer. Despite attempts to obtain comments from Qatar's government media office, no response was received. This transaction reflects the ongoing activity in London's high-end property market, which has remained relatively resilient amid global economic fluctuations and impending changes to tax regulations for affluent foreigners in the UK. While some sellers have adjusted their pricing expectations, the allure of prestigious London addresses continues to attract discerning buyers, including those from the Middle East. Mayfair, often dubbed Little Doha due to significant investments from Qatari elites, remains a sought-after neighbourhood for luxury real estate. In 2023, it accounted for a notable percentage of transactions involving properties valued at £5 million or more. However, shifts in buyer demographics indicate a slight decline in Middle Eastern purchases in London's prime postcodes compared to previous years. Despite these fluctuations, London's luxury property market continues to draw interest from affluent individuals worldwide, reaffirming the city's status as a global hub for prestigious real estate investments. Revised expectations for a delay in the base rate cut could potentially hinder the recovery of the UK housing market, according to recent analysis. Bloomberg Intelligence's assessment of the housing market suggests that postponing the reduction in the central bank rate has resulted in some reversal of the favourable mortgage rates witnessed earlier in 2024. Data from Moneyfacts further indicates a gradual increase in the average two-year fixed rate, nearing 6%. Despite these challenges, there are signs of improvement in housing market activity, notably reflected in the surge of mortgage approvals for house purchases to their highest level in nearly 2 years, as reported by the Bank of England. Additionally, average house price movements have shown subtle month-on-month changes. Bloomberg Intelligence anticipates modest low single-digit house price growth for the year, highlighting the potential for an easing in house price-to-earnings ratios to enhance mortgage affordability and sustain market activity. However, market expectations for Bank of England base rate cuts have been revised downwards, with projections suggesting a more restrained rate of reductions over the next 3 years. This adjustment contrasts with earlier forecasts, indicating a slower path towards rate decreases. Bloomberg Intelligence warns that this scenario, coupled with moderate rate cuts, could result in a sluggish recovery for homebuilders. Nevertheless, sentiment towards the UK housing market has become more positive, with buyers increasingly reassured by its stability and adjusting to higher interest rates. Bloomberg Intelligence suggests the possibility of pent-up demand being unleashed, especially considering the significant decline in mortgage approvals and transactions observed in late 2022 and 2023. Moreover, London's housing market, which experienced underperformance in house prices, is witnessing a resurgence fueled by improved affordability. The return to office-based work is contributing to this trend, with shorter commutes gaining prominence among prospective buyers. Entrepreneur Bassim Haidar's decision to depart the UK due to the planned abolition of the non-domicile tax status has ignited discussions about its potential repercussions on the country's tax revenue and economy. With a portfolio spanning over 10 properties in central London and a significant financial presence, Haidar asserts that remaining in the UK under the revised tax regime would incur exorbitant tax liabilities, prompting his relocation to tax-friendly jurisdictions like Monaco and Dubai. Expressing his concerns, Haidar emphasises the significant loss of tax revenue resulting from the departure of non-doms like himself, who contribute a substantial amount to the UK's tax coffers. He contends that the government's aim to raise £2.7 billion through the abolition of the non-dom scheme may backfire, as departing individuals will no longer contribute taxes on UK income, capital gains and VAT. Moreover, Haidar anticipates adverse consequences for the UK economy, citing the potential reduction in spending from wealthy non-doms and the resulting impact on businesses and employment. His decision to relocate also entails implications for his household staff, whom he regrets having to make redundant upon his departure. In proposing a solution, Haidar suggests the implementation of a flat tax for non-doms, similar to schemes in other European countries, as a viable alternative to retaining high net worth individuals and safeguarding tax revenue. He underscores the importance of considering the long-term financial well-being of his family, including protecting their wealth from inheritance tax liabilities. Despite his attachment to London and its lifestyle, Haidar emphasized the necessity of prioritizing his family's financial security, leading to the difficult decision to leave. His departure, alongside that of other non-DOMs, signals broader implications for the UK's tax policies and economic landscape, prompting discussions about the balance between tax fairness and attracting global talent and investment. US investors are making a notable comeback in the London commercial property scene, marking the swiftest pace of acquisition in 8 years, as per data compiled by BNP Paribas's real estate division. This resurgence is fueled by growing optimism about Britain's faster recovery compared to the United States, which has faced tougher economic challenges. Globally, commercial property values and transactions have been hit in recent years, a trend echoed in Britain due to rising borrowing costs and reduced office occupancy post-pandemic. However, US investors are increasingly drawn to the UK market due to its attractive leasing fundamentals and the favourable exchange rate between the dollar and the pound. Conversely, concerns persist in the UK property markets regarding stable interest rates, delayed return to office settings, and political uncertainties surrounding the elections. In the first quarter of this year, US-based investors injected a significant £1.9 billion into London's commercial property sector, marking a six-fold increase from the previous year and the highest since late 2015. This influx of capital signals a robust return of US investment into the market, according to Fergus Keane, head of Central London Capital Markets at BNP Paribas Real Estate. Notable transactions include MCR Hotel's acquisition of the iconic BT Tower for £275 million, destined to be transformed into a luxury hotel, and Elliott Management and Oval Real Estate's joint purchase of a mixed-use portfolio in London's West End for £300 million. Across Britain, US investors deployed £3.1 billion in property investments during the quarter, a substantial increase of two-thirds from 2023 and the highest since early 2022. The resurgence in US investment is also influenced by domestic political tensions, adding momentum to the influx of capital into the British real estate market. Knight Frank's research, covering 19 major markets, suggests that Britain stands to benefit the most from US real estate investment overseas, with a significant sum of $13 billion poised for deployment, up from $10 billion in 2023. Coutts Bank is gearing up to move billions of pounds of clients' funds out of the London stock market and into foreign company shares, dealing a significant blow to the city. The 332-year-old institution, renowned for its high-profile clientele, including King Charles and former UKIP leader Nigel Farage, is set to shift £2 billion from British funds into overseas investments. This move, as noted by Charles Hall of investments bank Peel Hunt, underscores the ongoing trend of capital outflows from the UK. Coutts' Chief Investment Officer, Fahad Kamal, highlighted the disparity between UK stock allocation in portfolios and their global representation, signalling a recalibration towards a more globally diversified approach. This decision reflects a lack of confidence in Britain's economic outlook, raising concerns for policymakers seeking to stimulate growth, with British stocks deemed undervalued compared to American counterparts and firms increasingly favouring Wall Street over London. Coutts' move mirrors a broader trend. The planned withdrawal exacerbates the significant outflows witnessed in UK equity funds, adding further downward pressure on already depressed market valuations.
Subscribe to our newsletter to receive our weekly bulletins and stay ahead of what's shaping the super prime property market.